Good morning and happy Monday. Welcome to Keeping Current Matters' latest deep dive. I'm so glad we're able to be together this morning. Let us know in the chat box where you're hailing from, and I hope you are starting a good day. And if not, let us know how you're feeling. I know that today's both economy and markets it can generate a lot of feelings, and so in that regard, I hope that today's deep dive will offer some more insights into what we're seeing in the market and how you, in a sense, can leverage some of this information when you talk with your clients, be they buyers or sellers. So with that, let's get started. So good to see you. I'm going to share my screen, and you will see that the focus of my presentation this morning is really on a handful, maybe two or three of that, of spring market drivers. And when I say spring market drivers, what I really, in a sense, focus on is what is driving activity, right? As we chatted over the last few weeks, we have been really spending the last 8 to 9 months under this umbrella of concern, and you and I have touched on these topics. We've heard from headlines that due to the Federal Reserve's monetary tightening and inflation pushing mortgage rates, 300 basis points or more last year compared to January starting at 3%, October, November being over 7%. Somehow that was automatically going to drive housing market into an irreversible crash. The reality is that the data is showing a much more nuanced environment, both economically as well as from a housing standpoint. And on the housing end, you're in the market every day. You've been watching these trends. Yes, we saw a pullback in buyer traffic. And last week, we chatted about buyer traffic a little bit. We saw that in the second half of last year. We also saw, as I highlighted last week, that the first quarter of this year, we saw buyer traffic rebound and increase January, February, March, noticeably every month. So with that in mind, the big question for me is, how is that buyer traffic translating into transactions? So let's get started this morning and move to one of the first drivers, and that is sales activity for existing homes. The data came out this last week, and what really stands out to me in the data, number one, we saw a rebound in sales. And you see on in this graph, there was a slide, noticeable slide in 2022 through January of this year. But as I pointed out last week, foot traffic picked up in January, then went higher in February, went higher in March. You saw that rebound in sales in February. February sales actually jumped up. You see the noticeable bump up there. But then since then, we've seen slight sliding back in sales. On the upside, as far as I'm concerned, transactions are still taking place. In fact, when you look at the April data, we were at an annualized pace of about 4.3 million sales, which, considering that we've been laboring under the shadow of, oh, the market is going to crash, this is not a crashing market, right? This is basically a market that contends with some constraints. But by and large, what we're seeing is buyers are trying to make a deal happen. The real challenge buyers are having are really multifold. And the main one, right, is inventory. And I know many of you, if someone were to ask you, right, what's holding up the market, your answer will be pretty straightforward. Hey, show me a house and I'll sell it, partly because you're seeing the demand in the market rebound this spring. The trouble is a lot of new listings, homeowners are still not internalizing the fact there's not a housing crash. Home values have been resilient and buyers are actually out there. So with that, what's interesting to notice in the sales data is that there's a specific geographical nuance to it. On a monthly basis, transactions took a step back across the country, but what really drove the bulk of that were transactions on the West Coast, right? Western markets have seen significant surge in prices. They've also been feeling the pressure from a lot of the tech layoffs of the last 6 to 8 months. And as a result, we're seeing sales transactions there on a monthly basis pull back much more strongly. And so that's really driving a lot of the national slide in sales. So when you look under the hood of the market, aside from inventory, which is sort of a main headline concern, what else is driving the transaction in the spring? Obviously, affordability, or in some markets, particularly the Western markets, lack of affordability. And here's really a picture that's worth at least 1,000 words. When you look at affordability, and this is the Housing Affordability Index from the National Association of Realtors, and you see it's put out regularly. You see this going back all the way pre-housing boom in the mid-2000s. Then you see in the orange bars the housing bust period, when we saw the influx of foreclosures, when we saw really property values decline significantly. So did affordability increase. The trouble, of course, at the time, in as much as homes were affordable, a lot of people couldn't qualify for a loan. That picture improved during that period, but didn't improve as much as it was pre-housing boom, mid-2000s. And what we see now in the blue bar, the latest reading of the affordability index, is it's well below historical average. So it basically shows you that the three components, right? There are three components to affordability: price, income, and interest rates. All three of those right now are really making it challenge, the combination of those three, challenging for buyers. However, it's not all dire. The one thing to understand and realize that interest rates obviously drove these affordability challenges, particularly when combined with prices over this past year. And you see here the monthly payments for a median priced home really peaked in October of this past year. And you may remember that was the month during which Freddie Mac's 30-year fixed rate mortgage crested 7%, and it went to 7.1%. And I know for some borrowers, that was just the average. For some borrowers, the rates were even higher. Since then, we've seen a slight improvement, but we're still roughly around the $2,000 a month. That's significantly higher than it was 3 years ago, 4 years ago, 5 years ago. So obviously, for a lot of buyers today, the big question is, how can I make this payment work, rather than, should I even bother buying a house? That question is obviously settled. People are still interested in that. So with that, I wanted to take a slight look again at the geography of affordability. And what you can see here, and on this chart, you're seeing two different data points. The blue bars are highlighting the median household income across the country, as well as each of the four main geographic regions. The color bars, the orange, green, and red, are the qualifying income required to get a loan for a median priced home. And here's where you really see the story unfolding. Whereas nationally, the qualifying income and the median income are fairly close. That relationship really diverges sharply in West Coast markets, where you can see that the median income for a household is a little shy of $100,000, but the qualifying income required to afford a really high-priced median home is north of $140,000. So if anything, when you look, and you might remember from last week when we talked about foot traffic geographically, and we saw the Northeast and Midwest really outpace the nation in terms of buyer interest, you can really tell why. Affordability in the Northeast, particularly affordable Northeast markets, as well as the Midwest region, is driving a lot of buyer interest and buyer activity. Meanwhile, of course, the Western market still lagging, and even Southern markets, which during the pandemic saw a huge influx and migration of people, are also feeling a little bit of that affordability pressure. And to put this into a historical perspective, this is the percent, what you see here illustrated, the percent of median income needed to purchase a median priced home. And you can tell the 1985 through 2000, that was a relatively affordable 21%. In 2006, you may remember that period, sort of the peak of the mid-2000s housing boom, that percentage crested 25%. By comparison, right now, today, we're roughly in the same ballpark. The good news is, and you are fully aware of this, today's market is not the same as 2006 in terms of financing, in terms of market fundamentals. We are in a different environment. However, the combination of inflation, prices, and interest rates is really making it challenging. Here's the silver lining. And this is something I touched upon a couple of weeks ago in one of the other deep dives when I was talking about employment. Remember the three components: prices, interest rates, and income. On the income component, what we're seeing is continued increase in prices, in wages, and this is helping a lot of borrowers overcome some of these challenges. And on that topic, I want to touch on inflation for you because I think it's so closely tied together, both to wages as well as interest rates. And what I'm wanting to highlight for you here is that inflation, which we've been really struggling with over the past year, to the point where last June, you may remember, we saw inflation hit a 40-year high, has been noticeably moderating. The Federal Reserve's tightening measures, right, increasing the short-term funds rate, are having an effect. In fact, we saw inflation in April retreat to about 5%. That's the good news. The reality, of course, it still remains well above historical averages. You look at the 1983 through 2023, right? 4-decade period, inflation was running about 2.8%. So we're still almost double that, but we're moving in the right direction. Importantly, we're seeing some items like used cars and trucks, utility costs, fuel costs, oil begin to wane, but for everyday items, a lot of Americans are still feeling the pressures of higher prices, whether it's food, whether it's shelter, the rent components still rising, grocery store prices are still rising. And here's where the two come together when I mention income and inflation. What you see here in the orange line are the average hourly earnings. The blue line is the consumer price index, one of the measures of inflation. And you see this relationship. I mapped it out here for you going all the way back to 2007. Anytime you see the blue line above the orange line, it tells me that inflation is running ahead of people's wages, right? It's a period in which, by and large, people are feeling that even with a pay bump, they're, in essence, getting a pay cut. And you can tell in the graph on your right, the last year and a half or so, that blue line really shot strongly above the orange line, meaning inflation outpaced our collective wages by a wide margin. So for a lot of people, they said, yeah, I'm getting a pay increase, but it doesn't feel like it. And this is a main reason why. What to me is an encouraging sign. When you look at those two lines, that blue line is beginning to converge now towards the orange line, meaning wage gains are almost matching inflationary pressures. This is good news. It means for buyers, at least on the wage component, on the way of the three components, price, interest rate, and wages, on the wage component, they're making a little headway. So I expect that situation to improve. And here's why that's so important, particularly as I touched on the Federal Reserve's actions. The Fed is right now focused on avoiding a repeat of the mistakes the central bank made back in late 1970s, 80s. I know a lot of you remember very well, and some of you even mentioned to me in the past that, hey, listen, today's rates may be high for a lot of young buyers, but when I bought my house, I had a 16% interest rate, so they're not that high. What you see here is the consumer price index, the CPI, going back to the mid-1970s. And you see late 1970s, inflation really shot up for various reasons. The Fed pushed for monetary tightening, but when it saw the rates come down, the inflation rates, it said, okay, I think our job here is done, and they paused. What happened then was a resurgence in inflation in the early 1980s, which then ended up with Paul Volcker, who at the time became chairman of the Federal Reserve, resorting to an whatever it takes approach to quash that inflation. And then you see that double header on that. So when you look all the way to your right, you see today's inflation trajectory. The Fed is really focused in trying to make this a one and done monetary tightening, which is why it's been so strongly pushing for rate hikes. We've had 10 consecutive ones in the last roughly year. This last week, we saw the chairman indicate of the Fed, Jerome Powell, indicate that a pause might be appropriate at its June meeting. So clearly, even the Fed is trying to make sure it doesn't kill the economy in its pursuit of taming inflation. But I wanted you to be aware of this, so that when you look at the big picture and you hear, well, the Fed is tightening, the Fed's not tightening, this is really what they're trying to target. So with that, what does this mean for real estate specifically? And here's a graph that I'm hoping will answer some of that, and one I know you are paying close attention to as well. It's the consumer price index, right? One of the inflation measures, mapped right alongside the Freddie Mac 30-year fixed rate. And what you can see, again, going all the way back to the mid-1970s. And what you see, the relationship between the two lines, Freddie Mac's rate in the blue, inflation in the green, you see inflation tends to move roughly in tandem with mortgage rates. The distinction being mortgage rates lag inflation. They move a little bit later. So inflation goes up in a matter of a few months, so do mortgage rates. Inflation begins to come down and then drops down. A few months later, mortgage rates tend to do the same thing. And so when you look all the way to the right of the graph today, what you see that inflation measure really go sharply up last year, the green line, and then begin to come down over the last few months. You also see, with a delay, mortgage rates begin to sharply move up. And now for about 8 months or so, they've been bouncing around, going sideways between 6 and 7%. If the current rate of inflation continues to steadily decline over the next few months, we can expect, again, with a slight delay of a few months, mortgage rates to also follow suit. So for me, this is something I'm watching very closely, and I wanted to make sure you are fully aware of this trend as well on this Monday morning. So the basic question ultimately for me is, how is this information helping you make transactions happen, inform your clients, keep them in the know, so when they make a decision whether to sell or to buy, they make it in full confidence. So one of the tools I wanted to highlight this morning, of course, are the monthly market report. You can find it, of course, at trykcm.com/MMR. And at the same time, if you have questions, if you have concerns, don't hesitate to send them our way. I'm glad to chat with you. So with that, I conclude my remarks. And Jessica, let me know if we have any questions from any members this morning.
Hi, George. Great job. We did get just a couple of questions. The first one is from Robert, who said, I heard an economist advise potential home buyers that they should wait a couple of years before buying. Granted, it's without context, but looking ahead, is there any truth to the notion that buyers will be better off in a couple of years?
Robert, thank you for that question. In fact, it is such an important and B, timely question, because I know for a lot of people in this country, that is a tremendous driver of anxiety, frankly, and I've heard it in my conversation with buyers. Here's my view, and to your point, I'm so glad you highlighted there was no context to that statement. In my conversations, and I get questions like that from people looking to buy. Should I buy now? Should I wait? Here are the things I like to highlight for people. Number one, I want to ask them, what is your time horizon, right? If you're young, if you think that you might not stay in your current job or in your current location very long because you might change employers, you might change cities, in that case, I generally recommend people to maybe wait and not really hurry into the market, because buying and selling are not cost-free transactions, right? So if they plan to be in a location, in my view, in the current environment, about 3 to 5 years, there's not necessarily a better time to buy for no other reason than prices are not really declining. And here's key, and I think an important consideration for a lot of buyers who have been internalizing the idea that a crash is coming. The market fundamentals, demand versus supply, are such that they don't really warrant a real sharp drop in prices. We are still underbuilt. For over a decade, in fact, of population growth, we have not built enough homes. So my advice is, if you're going to be in your current location or job less than 3 years, for that reason, it might be worth waiting rather than just market drivers. On the other hand, if you feel stable, if you have a down payment amount, if you can qualify for a loan, if you have enough savings to last you roughly 6 months, the big driver of buying today is the fact that, number one, you lock in a fixed monthly payment, which, as you know, can really be helpful in an environment in which prices are still rising, rents are still rising, and home prices for the better part of what I'm seeing in the year ahead are not necessarily going to drop. This is a great time to buy. But again, circumstances really make a difference. So I hope that answered your question, Robert.
That was a great answer. Thank you for that, George. And I've got one more for you from Francisco, who said, how much of a change in home prices do you feel will happen as rates inch back to 7%?
Francisco, that's a good question. And within that question, I think there are several that we can tackle. The first one will be, number one, will we get to 7% again? From my perspective, I've been watching this, 6 3/4, 6 1/4, 6 1/2, 6.3, really bouncing around that, mostly on account of what I'm seeing in capital markets, looking at the 10-year treasury, looking at what the Fed is doing. For a lot of investors, they are waiting for more clarity on where the Fed's policy is going, and importantly, where the economy is going. Headlines have been predicting a deep recession for 8 months now, simply because Fed pushed rates higher. All the while, the Fed is trying to be mindful of that and saying, we don't want to kill the economy just in the name of squeezing inflation out. And when I look at the economic data, the data still points to a resilient economy. So that being said, in terms of pricing, I see two things happening. Number one, at a national level, I see market fundamentals continuing to play a role, meaning with a tight supply picture and really tight inventory, there's not a lot of pressure on prices to decline. That's one. Number two, I see a lot more geographic differentiation. So there are some markets, particularly affordable ones with strong local economies, and as I pointed out, a lot of them in the Midwest, New England, where people are still seeing multiple offers. Homes that are coming to market in good condition and well priced are still getting multiple offers. And we're in May of 2023, a period where a lot of people called for a very different reality, right? At the same time, as I pointed out, markets on the West Coast, high cost markets, are feeling that pressure, especially if their job markets are also getting squeezed. So here, I think geography will play an important role this year, a much bigger role than it has played in the last 3 years, or for that matter, in the last decade, where we've seen a rising tide lift all boats, so to speak.
That was awesome, George. Thank you. And I think that's all the questions I saw come through. I did want to give just one reminder. I've seen a couple of comments about the data in the chat. If you want to see more of that, if you're a KCM member, you actually have access to, with both your monthly market report and your deep dives, if you go and download the PowerPoint versions from your member area, you can find the exact sources that we use in the notes section of those PowerPoints. So just so you all know where to find that.
I'm so glad you highlighted that, Jessica. And for all of you, thank you so much for joining us. And remember, next Monday is Memorial Day. I wish you a safe and happy time with your families, remembering loved ones. And we'll see you on June 5th again for the next deep dive. Have a safe, productive, and really enjoyable week. See you.